Hi, everyone. Welcome to the Timing Research Show for October 5th, 2015. Today we will be talking about the 106th weekly report from Timing Research. If you have not had a chance to look at this yet, just go to TimingResearch.com/reports, and you can download it there. My name is David Cosmeter. I'm the creator of Timing Research, and I have Dave Landry here hosting again. So I'm going to go ahead and turn it over to him.
Thank you, Dave Cosmeter, and thank you to Timing Research for having me back once again. Jonathan, let's go to you first. Jonathan Rose of ActiveDayTrader.com. Tell us a little bit about yourself and tell us a little bit about ActiveDayTrader.com. Jonathan's new to the show, so welcome aboard, Jonathan.
Cool. Thanks, Dave. Jonathan Rose, Active Day Trader. Been in the markets for 18 years, last 4 as an options market maker. And what we do at Active Day Trader is we take my trading style, which is I find trades using fundamentals, and then we manage those trades with technicals. So I'll never really go into a trade on technicals alone. I always need some kind of valuation metric to get into a trade, and then we use the technicals to kind of manage that trade once we're in there. And we also, just real quick, the difference I would say with the Active Day Trader, it's more about talking about specific trades or trading styles than overall trading.
What would be a valuation metric?
A valuation metric would be being able to buy closed-end funds at a discount, looking at short-term options and finding cheap volatility compared to historical.
Okay, and that's considered, that's the fundamental aspect, you would say?
Yep.
Okay, cool. All right. Next up, we have Wiz. For those of us who know him, for those of us who don't know him, Matthew Buckley. He's a veteran, so God bless you. Thank you. We appreciate your service. Matthew's with Top Gun Options. So Wiz, take it over. For those of us who don't know you, tell us a little bit about yourself and tell us about TopGunOptions.com.
You bet. Thanks, Dave and David. Appreciate it. Like you said, Matthew Buckley, call sign Wiz. That's a 10-drink minimum. As to how I earned that call sign and maybe a demonstration. But Top Gun Options, we're actually going on our 5th year in business. Actually was partners with JR up in Chicago, so I know JR really well. Hell of a trader. And looking forward to hearing what he has to say, to pick his brain and vice versa. So very, very smart dude. But Top Gun Options, folks, we believe really trading is a form of combat. At the end of the day, somebody's going to win and somebody's obviously going to lose. So I took everything that I learned flying fighter aircraft and applied it to my trading, having a strategy, contingency planning, knowing when to eject, not emotionally, but based on data and getting out of a bad situation before it gets worse, knowing when to declare victory and also get out. We use everything when we trade, just like combat. I make the analogy that at Top Gun Options we're kind of an AWACS. If you've ever seen that airplane that looks like a UFO landed on top of it and is carrying it away, there's like 24 guys and gals in the back doing all sorts of stuff. So we have technical analysis, we have vol arb traders, we look at fundamentals, we look at everything before we get into a trade, and we have an absolute blast doing it. So looking forward to a good session today.
Cool. Are you going to be at Traders Expo in a couple of weeks? I know you do a lot of traveling.
I might be. I was just out in Vegas last week, and the cops are still looking for my liver. Is it in Vegas or?
Yeah, it's in Vegas. No, I was going to try to cash in on a 10-drink minimum to get some stories out of you, but.
Let me check my schedule, man. I'll see if we can hook up.
All right, cool. Next up, we have Neil Batho from TradeReview.net. Neil's a veteran of the show. I was asking him before the show if he was homeless because he never stays home. He's in Thailand. He's in Canada this week. He was in Europe last week, and I don't know where he was the week before, but I'm sure it was someplace exotic, maybe more exotic than Canada. But Neil, take it over. Neil Batho of TradeReview.com. Uh-oh.
Things firsthand, don't I, Dave? Come on. Well, I've been running Trader Review for several years now, and basically the focus is timing the risk. And if you're timing the risk properly, I believe that you can trade with low risk and get high gains, because when you're looking at the technicals and everything's lining up perfectly, all the stars are aligning, everything, I consider that to be low risk. you get into the trade. I specialize in timing the entry points, and when you can time the entry points, you'll get real fast moves as things start to go. And so I'll trade the trend as long as I can. But what I've often found, especially with the options part that I have to my service, is when you time that entry point and you get that move in just a couple of days, heck, you get out. You've already won. I don't need to buy leaps that go out a year. I don't need to think what's going to happen a year and pay massive time premium. I'm just going to get in, and when everything goes well and we're up 100% in 3 days, we're going to get out, or we're going to sell half our shares and hold the rest until things look like they're peaking out. So I'll use a lot of technicals. I use point and figure, which almost no other newsletter uses that I know of, and I use the Ichimoku Cloud, which almost no one uses. So I'll try to show some charts of that as we go along.
Cool. Looking forward to it. All right, Jonathan, let's go back. Oh, I guess let me just introduce myself real quick. Dave Landry from TimingResearch.com. I believe when it comes to markets, you can only predict the short term. In the analogy I use every week, and I guess most of you are sick of hearing it, but it's like predicting the weather. If it's cloudy and thundering outside, you know it's probably going to rain soon, but you don't know if it's going to be raining again this time next week or next year or whenever. But you know there's a pretty good chance there's rain on the horizon. So predicting the market, I feel, is the same way. I think you could look out a few days and have a pretty good idea what the market is going to do, provided that you have some sort of setup in place or some trend in place. Some of my clients misconstrued that into thinking that you could always predict the short term, and no, you can't always predict the short term. But if you have a nice trend and the market pulls back and it begins to resume that trend, then there's a chance that that trend will continue on for a swing trade. Now, I'm slotted as a swing trader, but I will stay with positions as long as they move in my favor via a trailing stop, and I will take some partial profits just in case that trend doesn't materialize. And that's pretty much the crux of my methodology. I have a 21-page report on that. That's on my website for anyone who's interested. It's under free reports, or you can go to products, and it's the first thing under products. And again, that's free, and there's some other reports there too. I also have about 1,400 YouTube videos, so if you're interested in knowing more about the methodology, you can get started for free. All right, Jonathan, let's go to you. Jonathan, based on any technical fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower from Monday's open, that's today's open, to Friday's close, and that's October the 9th? And then based on your prediction, rate your confidence to your answer by estimating the probability you have correctly predicted this week's market move. And then in the next question, just so because you're new to the show, you will get a chance to elaborate on that further. So just give us a quick answer now, and then we'll ask you to elaborate in the next question.
Well, sure. I guess I get a 27-point head start considering the SPX is up 27 points already. So, again, I don't really predict whether we're going to go up or down. In this forum, sure, above 1970, I'm bullish on the SPX. But again, that wouldn't be a reason for me to get into a trade. But I would say, bullish over 1970. So if we're over 1970 now, I'll continue to be bullish.
Okay. Confidence on that?
Confidence in the direction of the overall market? I'll say I'm 50% confident in that. I'll say I'm 51% confident of that because I have a little head start.
Okay. We had 100%, I think, last week. I forget who it was. All right, we're the same bet.
Did they bet $1 billion on their 100% confidence?
Yeah, I mean that's the thing. It's these guys get on TV, and if you do what they do, it's like why just sell everything and put it all in the market. Anyway, I saw your May just go by again there, Wiz. You're lucky guy.
Exactly.
That was a little earlier. Anyway, sorry about that. Wiz, same bad question, same bad channel to you.
Wasn't wearing the maid outfit, was she?
No, she looked like she was going to work out.
There you go. Good. I'm a little in JR's camp, but to be honest with you, when we have these Monday, well, you wanted the quick answer. I'll expand. I'm going to go neutral to slightly bearish with a 0.7 delta. I got a weekly options trade on that we'll cover, but I'll let you know why. So I'm neutral to slightly bearish. So I think by Friday we're either unched or lower, and I'll let you know why in a couple minutes.
All right, cool. A little bit of a teaser there. Cool. All right, Neil, to you. Same question. You've been around. You know what we're asking.
I'll say bullish unless we get 2 huge rallies tomorrow and the next day. Then I'll just get out for the week. So
Okay.
that's pretty much my answer, and I guess I'll elaborate a bit later.
All right. Confidence.
65, 70.
All right. We'll go with 65. Okay. I'm gonna say lower. I don't have a particular setup. Like as I said earlier, if I have a setup, then the prediction becomes a little bit easier. As a trend follower, I think we have rolled over here. I think the momentum has left the market, and I think we have a lot of overhead resistance. And I'm going to flesh these things out in the next question. So I'm going to go with lower, and I'll give it a confidence of. I think I'll go with Neil's prediction of 65% on that. All right, Jonathan, you're up next. What developing events, technical, fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 or other U.S. markets?
Sure. So again, I said higher, 51%, and I only said 51% because what we try to do is if the market is strong, then we look for pockets of weakness in a strong market. And those are the trades that we're going to have a lot more confidence in than the overall direction of the market. I think the biggest event this week is going to be at FOMC minutes come Thursday. There's a vol-inducing event come Thursday, so I wouldn't be surprised if the VIX continues to come in until then.
Okay. Or the next, when we get to the next question of the VIX, if you want, you feel free to share your screen. Or if you want to share your screen at any point in time, feel free to do so. In fact, we encourage you to do that if you like. Wiz, let's go to you. What developing events, technical fundamental, will we be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, a couple things, man. This is an absolute clown car, which we'll get into in the later here. But what's going on in the Middle East? You know, last week Obama said, well, Syria is not a superpower chessboard. Well, it is to Putin, and you're playing checkers, dude. So we got a lot of volatility in the Middle East. I look at this from, this ain't rocket surgery. Here's the world ending because of China. Holy crap, cats and dogs living together, mass hysteria. That wasn't going to happen. So we didn't get right around there, and I'm not drawing it right here because it suits my argument. That's literally about half the rip your face off implosion. So there's your dead cat bounce. There's us going into the Fed meeting. There's a yay moment right here after the Fed meeting going, hey, they didn't raise interest rates. And then here's a boo moment saying, well, they didn't raise interest rates, which means that they're creeped the hell out from what's going on. Mm-hmm. Now we're back to smoking the hopium with a yay moment that, hell, Goldman Sachs came out a little while ago and said, we don't even think it's 2016 now. Hell, Goldman Sachs, which runs the Fed, as everybody knows, higher probability of liftoff not in 2016, but in 2017. But I think that's why this week's critical. If we can break through this it's 1990. It's 1990. I got big hair. I'm getting ready to graduate from college. If we can break through 1990, we got some serious airspeed to the upside. But this is why I think this is going to be a little bit of a holding pattern over O'Hare right here until we can get some further clarity that, all right, no kidding, let's get on board the hopium and get airborne. So that's what I'm saying. Those are the events for the week. Is usually when we see this rip your face off rally on a Monday, by Friday afternoon everybody's like, all right, that's a little bit of enough. That was a little too far, too fast. So that's the main thing I'm looking at.
Early in my career, a friend of mine used to joke, he called it the Would I Buy rally. It's like people would, now would I buy? It's like he get these big rallies, and then the next few days they fizzle. And that was back when people actually had to call their broker. They call up the broker and say, now what did I buy? So
exactly.
That's kind of funny.
Right now it's kind of a Seinfeld rally. It's like it's a rally on nothing other than bad news being good news. And we'll go over the payroll stuff maybe later, but yeah, that's kind of my ammo behind what I'm doing.
Cool. All right, Neil, let's go to you. Same question.
Yeah, just bringing up a chart real quick here. Let's see, let's share the chart. Hmm.
So look, you got to hit like an extra click after you hit share. Then you got to like click it again.
Okay, let's see here. Does this show up now, this chart?
Yeah, there you go.
Okay, so what we got here is what's happening is a big return of the commodity rally. Everyone has given up on the Fed. If you look at the U.S. dollar index, it's weakened significantly over the last couple of days. The commodity-based currencies are going up, the Aussie, the Canadian, and you look here at oil, it's just going sideways. So what happens when something like that goes sideways, the underlying commodity for so long? The stocks that are based off that commodity say, okay, the risk of this going lower is severely diminished. That means the stocks are oversold, so the stocks are now going to rally. So I bring up here Chevron, and we bought calls on Chevron on Thursday, and we're up almost 100% so far. I'm looking here at the cloud. The top here is resistance. That's where we're going to get out of half our shares, and we're going to let the rest try to run to another objective that I have. And so if you look here, I'm going to bring up U.S. Steel, which everyone has forgotten about, but I still monitor it. And you may not know, but 1/3 of all shares outstanding on U.S. Steel are short as of yesterday, which is massively significant. So now we're going to get this huge short squeeze that I think is going to happen on U.S. Steel. And also the dollar goes down, U.S. Steel goes up because the U.S. is exporting steel, making money just in numbers, but so that's what you have here, and that's kind of a free pick I'm going to give away is U.S. Steel now. And then we also have to look at the S&P 500 and look at the Dow. I think the Dow is a little bit more heavily weighted on oil, so it could rally more percent-wise than the S&P 500 for this week. But what percent of stocks in the S&P 500 and the Dow consist of commodity stocks? And that's been diminishing a lot over the last couple of years. In the 2000s, it was increasing. So now when you have a commodity-based rally, that ratio will change what commodity stocks are a percent of those indices. So I think the commodity stocks can make this rally continue for several weeks, maybe even several months, as everyone has given up on the Fed. I don't think they're going to raise rates, heck, till next summer at the earliest, especially with what's going on overseas now. Everybody wants free money, including the government. So
yeah, I think like Wiz, I think it's Wiz. I'll give him credit because it sounds like something he would say. The old kick the can down the road is what I think that's what they're going to continue to do as long as they can.
Inflation
cool.
will continue. Inflation is going to continue. They're going to say there isn't inflation, but there's 5 to 7%
There is no inflation. There is no inflation. Bite your tongue.
Look at hotel rates. I know.
Yeah, you know, as you travel the world. Okay, S&P 500. There's a couple things I want to cover. There's a couple things I want to dovetail in on what Neil said too. First of all, I think we have a mountain of overhead resistance in here. I usually don't use many indicators, but when the market begins to roll over, I like throwing a couple of moving averages in, and one of those moving averages is what I call the bow tie moving average, and it's just simply a 10-day simple, a 20-day exponential, and a 30-day exponential. And when they come together really tight like this and form, it looks like a bow tie. That's why I call it the bow tie. And begin to spread out again, usually those signals can be fairly powerful. And on a weekly basis, we did have a trigger on that. We have obviously a bounce in here. I think Wiz called it a dead cat bounce in all of his feline and canine analogies, but I agree with him so far. Last couple times the market did this was in 2000 and 2007. I think we all know what happened afterwards. So not that it's going to work again this time. I mean, maybe it's due not to work. I hope it doesn't work. I would rather trade an eternal bull market. Like Neil alluded to, I'm starting to like commodities in here. I think they're kind of scraping bottom. We are along, full disclosure, USO, and it hasn't set the world on fire just yet, but it took off from lows. It made a pattern I call a first thrust. We have a big thrust from lows, and then so far it's just kind of died in here, but it hasn't done anything wrong. It's kind of hanging in there in spite of the Saudis going to dump oil and all these horrible things. And the other thing too, it's interesting that Neil brought up those oil field stocks, is that reminds me, I think we're scraping bottom in the oil field stocks. and I think we could see a bottom there soon. Not that I never confuse the issue with facts by interjecting fundamentals, but I do live in South Louisiana, and the talk is these oil companies are having massive, massive layoffs. Every time you turn on the news, or my wife turns on the news, I try to avoid the news at all costs, but I can't help to get a little bit through osmosis. You hear about all these oil companies that are laying off, and you can see that it's still in a longer-term downtrend. These are the energy stocks, but they're beginning to scrape bottom. And notice that this low is a little bit lower than this low, with like a double bottom pattern. I like it when the second low is a little bit lower. It kind of fakes everybody out a little bit. And so far, we've had a decent rally off of lows. So I'm not going to rush out and buy a bunch of stocks just yet, but I'm waiting for setups. As I often preach, you get signs, and this could be a sign, this double bottom in here. You get a signal, something like a bow tie when these moving averages come together and spread out. And then you get your setup when the market begins to pull back a little bit. And then the final piece of the puzzle is the entry. You wait for the market to go back in the intended direction. And then, of course, we could always be wrong in our trades, as everyone here knows. So we put stops in place just in case. But I'm keeping an eye on those commodity-related stocks. What I like about those guys is they can trade contra to the overall market. You don't want to buy them just because they can trade contra to the overall market. Easy for me to say. But wait until they rally off their lows a little more and begin to pull back. And I think we could get some wonderful setups there. I think the market is dicey, as Wiz kind of pointed out quite a bit, in Bizarro land and all those other things that he said. So I'd be very careful for now, especially with the amount of overhead supply we have in the market. And the other thing, too, that I often forget to mention is since 2009, we've been in this eternal sunshine environment where everyone's just happy because they're making money. But now the market's beginning to roll over a little bit in here. And I tell people, well, markets go up and markets go down. And they say, well, duh. And then they go on to tell me why it's going to come back. And, you hate to say it's different this time because you get in a lot of trouble, but it sure feels like it's a little different this time. And I think anyone who's purchased since 2009, and especially those people who have bought in more recent times, are beginning to they're being forced to question their purchases. Okay, let's go back to you, Jonathan. Did we got everybody, right? Yeah. Question of the week is, let me get to it. It's a repeat, I think, from one we had recently. And it says, the VIX has made some unusual large moves in the last few weeks. Have you started paying any more attention to the VIX recently? And that's to you, Jonathan.
Oh, cool. Thank you. This was interesting to me. Going over the answers, I noticed 37 or 38% of the respondents kind of dismissed the VIX. I want to go to... Does that look good? Dave?
Yeah, you got it now.
Okay, cool. So what I did here is SPX on a 30-minute chart, and then all I did was I put the VIX on it, but I inverted the VIX. So I just put minus VIX just to show the correlation between these two instruments going back over, I don't know, 5-6 weeks. They're pretty much moving. Right now they have a negative correlation, -1, but if you flip them over, they're moving lockstep. So to dismiss the VIX, I'd be real careful with that. But the other thing to note is you don't necessarily need the VIX. You could look at beta. You could look at straddles. So, I just put this together real quick because some of the answers, I just want to go over a clear understanding. So if the VIX is at 20 and the SPX is at 1970, this is how the VIX works. VIX 20, we divide it by the amount of months, and then it's just saying that the market's pricing in a 5.8% move. The price, 1970, times that 5.8, 114. So right now, VIX at 20, the range for the next 30 days that the market's pricing in is just between these two levels. And it's saying the VIX, it's one standard deviation, so it's 68%. Or you can look at the straddle over the same time period, and that's 50%. So I wouldn't dismiss the VIX. The VIX is very telling, and it tells real-time kind of supply and demand in the market. It can give you an idea. Even if you don't want to trade the VIX or trade volatility, it sure can help you manage your risk because you need to trade different size if the VIX is at 15 or if the VIX is at 30. So it's kind of what I wanted to touch on in relation to the people out there who are dismissing the VIX or might not necessarily fully understand exactly what it is.
Yeah, but statistics are worthless. 75.3% of all people know that. No, I like what you did, Jonathan. I never thought, I'm sure Wiz is going to laugh at me, but he always laughs at me, so I don't care. I've never thought about breaking it down day by day and looking at what it's actually predicting on a statistical basis. So that's kind of cool, and I always learn something in these shows, so I appreciate you doing that.
Yeah. Sure.
Wiz, to you next. I know you know a little bit about the VIX. You normally have a VIX position on every show, so do you have anything on with the VIX at this point?
Well, just like Blazing Saddles, let me say that Gabby JR is right. I love everything JR did. First of all, folks, the options. It's funny. No broker that I know of, like I'm gonna, it's funny, Dave. I'm gonna steal one of yours. You say that no broker that I know allows me to trade off the left side of a chart. The options market is the only thing that I know, the only vehicle that I know that's going to tell us with some degree of probability what range the right side of the chart is going to look like. It's almost like a cool trick to do at a cocktail party. Like, all right, anybody want to take any bets as to what range the VIX or S&P 500 is going to be between on this date? So, absolutely.
With you.
Exactly. And you guys, hopefully, if you're a regular viewer of David's show, you have this written down. If you're new, write this down. When vol is cheap, you buy it. When it's expensive, you sell it. It's that easy. Now, up until the world ended, the VIX had what we call a resting heart rate. Here's the resting heart rate of the VIX. The VIX, folks, reverts to its mean. Okay, I got my Navy shirt on. Why? Because at lunch I'm going to go, or my late lunch I'm going to go work out. But I can jump on the treadmill and do a 10 incline at 10 miles an hour. Well, that's pretty cool, Wiz, for about 15 seconds. And then I got to get back down to my resting heart rate. So the VIX is the same way. Mm-hmm. And I'm down here in South Florida, and it's kind of rainy today, but as hurricane whatever it was zipping up the coast, if you want to go buy hurricane insurance when you know that's coming, it's going to be through the roof. When it's sunny and clear out down here and there's nothing on the horizon, it's pretty cheap. The VIX is the same way. So here's the inverse of the S&P chart that I showed you recently. There's the world ending on China. It spiked, the uncertainty. Holy crap, China's going to bring us all down and end the world. I think the new resting heart rate of the VIX is probably, and again, I'm not paid by Goldman Sachs, but it had another great report that said something along these lines. Maybe they're a client of mine at Top Gun Options, because they said what I've been saying, which is the mid to lower 20s is the new resting heart rate of the VIX. I think vol is cheap at this point. To kind of steal a little bit of JR's thunder, I would be looking to get long vol, and as you know, one of the tactics that I like to employ is a bullish double vertical. And remember, let me wrap up before you guys move on. Remember that hedging against a spike in volatility is not the same as spiking as a hedge against the market pulling back. Those are two completely different things. Write this one down. VIX up, market up, something's up. The VIX can go up, folks, even if the market is up. And people look at me like the RCA dog, and I'm like, oh, yeah. Here's a perfect example. June of 2013, market was melting to the upside, and the VIX went from 12 to 24. Doubled. Yeah. And I show that chart, and people, 90% of the people get that wrong. I'm like, was the market going down or up when the VIX doubled in June of 2013? And 90% say down.
Every time you say that, and I'm glad you brought it up again for the new viewers, and as a reminder to me, but every time you say that, it makes me think a lot of people don't realize that the VIX is calls and puts. So people don't realize, or puts and calls, I guess you should say.
That's exactly right. It's a ratio of them. Yeah. And so, yeah, if you see market up, VIX up, something's up. And back in 2013, just to close out, for the people who are like, well, why tell me, when do we get to the fireworks factory? The reason the market was up and the VIX was up, because it was the Fed meeting where everybody thought the Bernanke was going to start the taper. So I think we're going to see the same thing going into, they'd be smoking crack if they did in October. December, we're going to see some vol. So December, we know we have a potential hurricane coming. large funds, financial institutions, retail institutional investors are going to have to hedge against the potential rate rise going into December. That would be a great time to be getting long vol, especially if, as Jonathan said, the VIX has a little bit more to come in here. I'd be getting long vol like you read about probably next month into December.
Okay. Yeah, I love that resting heart rate analogy. That's awesome. Neil, let's go to you. The VIX has made some unusual large moves in the last few weeks. Have you started paying any more attention to the VIX recently?
Well, here it comes. I'm not a big VIX guy, so on the after Jonathan and Wiz, also Jonathan's analysis of that was just awesome. Thanks for that. But I guess what I would look at the VIX is, because I do options as well, is if the VIX is super high, and it's just going to be too late to buy the puts. They're going to be way too expensive, and you're looking at options pricing. That's pretty much how it is. But now the VIX is down, and what's interesting actually when you look at the chart is if you look at the S&P 500 200-day moving average for a target, it's not something I usually do, but it's pretty much exactly where the breakdown was. And you could look at the same almost on the VIX. Just go down to the support where the VIX broke out, and that could be your target for the S&P 500. So that's pretty much all I use the VIX for is options pricing, and it's really inversely proportional, but that's what I look for.
Cool.
Not a big VIX.
Yeah, I agree with you. Jonathan had some good points too on that, and that's the problem with the show is we've been told many times we don't have enough controversy, but we'll get there sooner or later. I think Wiz and I, maybe Wiz and I will get into it at some point.
I personally can't stand the color of Jonathan's office. That makes me want to scream.
Yeah, what is that? That's horrible.
What is
mauve?
that? Yeah,
come on. Mauve.
Maybe I have to work on my lighting.
Is taupe a color? I don't even know what it is. That's taupe?
It's brown. It's brown. It's the lighting.
Brown. All right. Well, good. Finally, some controversy. I'm not a huge fan of the VIX. One thing that I generally tell people is make sure you fully understand what you're dealing with, and I'm friends with Larry McMillan, and he does, and I'm not just name dropping. I know these guys. We all know each other eventually in this business, and he does some really good presentations on the complexity of these derivatives and derivatives of derivatives. And a lot of times people are doing things, as I think Wiz pointed out, and they don't even realize what they're doing, and that's a great way to lose a lot of money. So, like Jonathan and Wiz both, make sure you dedicate a lot of time towards understanding the VIX. Now, many years ago, back in my mechanical testing days, I did publish quite a few VIX systems, and one thing I did discover is they work very well, and then they stopped working for a while, and then they started working very well again. And I think it comes back to what Wiz says about that, and again, I love the analogy, the resting heartbeat. So when the volatility tends to dry up, and stays dried up for a long time, these VIX systems, which are mean reversion, by the way, don't really work that well. But once everything wakes up a little bit, like it has recently, then they begin working a little bit better. And by the way, speaking of, make sure you understand the beast. The VIX is a mean reversion type of market. It's not a trending market. It's not a market. I don't know about support and resistance. Maybe what Wiz is talking about with the resting heartbeat. Maybe that can be support and resistance. But from what I've seen, it's mostly a mean reversion market. So the stuff that I did many years ago is related to moving averages. And every now and then when the VIX wakes up like this, I'll get a few emails from people telling me what signals are triggering. But yeah, do pay attention to it when it begins to really wake up. That big spike we had recently that you guys pointed out, that's when you know we're probably coming to a short-term low. When what did you call it, Wiz? Blood in the streets, or you had some kind of analogy for it? When the VIX spiked and the market was coming unglued.
I don't know.
Cats are loving dogs, or I don't know. Oh, that was the retrace rally.
Yeah, yeah, that's Ghostbusters.
Yeah, so just yeah, oh, I got you. That's what that's from. So it only matters when it matters. So when you see it really stretched, then something's going on. And then not to kiss Wiz's butt, but VIX up, market up, something's up. I like that analogy, and that's something that I'm going to write down this time so I remember it. But anyway, I think it only matters when it matters, and if you are going to trade anything VIX related, just make sure that that's a significant part of your life and fully understand the what the indicator is, if you want to call it that, or I guess it's more of a measurement, what the measurement is, and make sure you understand that there's not necessarily always a direct correlation between the market and the VIX, and some crazy things can happen, and just learn those aberrations. So make sure you just study them, study it carefully. Okay, Jonathan, let's go back to you. Any closing thoughts on anything we said today, or why you chose that hideous color of your office? Or I actually kind of like it. It's kind of pleasing to me. I'm kind of a taupe kind of guy. No, it's not bad. But anything you want to throw in, feel free. The floor's yours.
Sure. I did that example on the VIX more in response to the questions, and I love the format and I love seeing everyone's answers, but I just got a feel from the answers that some people shy away from the VIX because they're not so familiar with it. For me personally, I look at straddles for volatility. I don't trade the VIX. I encourage our subscriber base to pay attention to the VIX in order to manage their risk. Like I said earlier, if the VIX is 15 or 40, you can't trade the same size. There's just different movement priced into the market. But for me, when I'm trading options, I always go look at the straddle to find out, movement of the straddle relative to how volatility is priced. So I'll use the straddle more than I'll use the VIX. But I use that example in the VIX because that's what the question was. Sticking with the program.
Hey, well, we appreciate that. And your office is fine. We were just trying to get some controversy going. Wiz has always got to stir the pot. All right, speaking of the Wiz, to you, Matthew. Any closing thoughts? Anything you want to tell us about your website, TopGunOptions.com, or whatever?
Yeah, actually, check your emails, folks. We're going to do a live trading session and training session for Thursday at 1 and then a night session at 8 if you're interested. But in this market, folks, I talk about smoking the hopium. I have the wrong portfolio pulled up, of course. Nice job.
Did you say hopium?
It is.
Isn't that funny?
Yeah, the Fed.
I love that.
When you sign up for Top Gun Options, you're going to write down a lot of whizisms. I think we have like 2 pages of whizisms. But the market's going up on Fed hopium. And you know what? The old Wall Streetism, when interest rates are low, stocks will grow. When interest rates are high, stocks will die. Like I said, I have the wrong portfolio up. But on a day like today, for all the viewers out there, if your portfolio, I used Options House or Trade Monster, back in the day, JR, and we're at the firm that built Options House. If your portfolio looks all green on a day like today, you are wrong. That's pretty arrogant, Wiz. No, it's not. You're wrong. If your portfolio is all green today, you are not hedged. I would be taking a look at whatever it is on a day like today that you use to hedge is the SDS. I like SDS, the ProShares Ultra Short S&P 500, or even SH, which is the regular short. I don't care if it's buying puts on the S&P. I do care if it's buying puts on the S&P 500. Buying puts is stupid. Do a bear put spread. Have somebody else pay it for you. So I'm looking. We're actually going to do a live session tomorrow morning at 9 with my traders, where we're going to get long SDS with a bullish double vertical, because this is the market where you need an ejection seat. Like I said, trading's a form of combat. Somebody's going to win and somebody's going to lose, and you need to have an ejection seat. It's funny because people, when I put on these SDS trades, and we have a rip your face off rally today, and people are like, "Oh, Wiz, I lost money on SDS," and if I could reach through the screen and smack them, I would. You don't lose. I don't sit in this kitchen and write a check every month to USAA and say, "Man, I'm losing money on my home, life, and car insurance." First of all, it's on auto debit, so you don't even think about it. Until you wrap yourself around a tree, or here in Boca, we get a blue hair who backs into you, and okay, great. Now I'm very glad we have insurance. So what we need to do, folks, is we need to have insurance on, and there ain't a better day like today than to put some red in your portfolio, because a lot of the positions in the Top Gun Options portfolio, yeah, we trade the front months, October, November, December, but we also trade the back months. The 2018 option series are starting to come out, so we're getting long on like China, China, JP Morgan, the health sector. When those are getting a little kicked in the gut, on when the market pulls back, at least our front month hedges on SDS, they act like bilge pumps, right? The USS Top Gun options ain't going to sink. We're going to have our front month bilge pumps kick in and profit if the market rolls over. So maybe you can join us and check out what we do here at TGO. I'd really appreciate it. But good seeing JR and all you guys, and thanks for having me. I appreciate it.
No, glad you're here. I got a quick question for you. On the when you're doing, I often tell my clients to shy away from these inverted funds unless, now this is trading outrights, unless the market is really coming unglued, or if you're doing day trade. And on the inverted leveraged funds, the tracking error is abysmal because, without going into a lot of details, I mean, I know you know this, but the viewers might not, because they're trying to track day over day error, and that gets exacerbated on the short side, and especially with leverage. So the question, and I do have one, is how do your option strategies work with the tracking error? Does the tracking error actually work in your favor, or is that something that's a bit of a problem with the options?
It's more an option with just buying this ETF outright than it is with the options, and that's an 8-hour lecture on aerodynamics, to be honest with you.
Okay.
It doesn't impact, and let me correct you, David, at Top Gun Options we call them tactics. And options, there's no such thing in my opinion as an option strategy. A strategy to me is, win the war, and a tactic is guard this bridge for the next 4 hours. So to me, an iron condor, a bullish double vertical, a covered call, those are tactics that support a strategy, and I teach that at Top Gun Options. A strategy is short-term income generation, managing risk, saving for retirement, saving for college, buying a boat in 6 months. We're going to teach them tactics that support those different strategies. But the tracking, you're exactly right. These double reverse, inverse with the flux capacitor on backwards ETFs do have a lot of issues with was it contango, backwardation, and all sorts of stuff. It doesn't impact our tactics as much as it does an outright buyer of that ETF.
Yeah. Cool. All right, Neil, let's go to, thanks for the answer on that. Neil, let's go to you. Any closing thoughts or anything else you want to tell us about TraderReview.com?
I do have something, and I'm bringing it up right now. Remember in the last couple of shows we talked about the put-to-call ratio. I finally brought it up as everyone was chatting. So I'm going to bring it up here. And everyone can see that?
Yes.
And so I highlighted it, and you look at the put-to-call over here, 1.44. That was on September 28th, pretty much right at the bottom. And you can get this on CBOE. Just type in on Google put-to-call ratio, CBOE, and then XLS for the Excel spreadsheet. You can download it. It goes back to 2003. And anytime the market is really crashing, right at the bottom you get a huge number like this, 1.44. So obviously the calls here and the puts here, puts divided by calls, you get 1.44. And this is the only place I know where to get it. Almost no one talks about it, but if you keep scrolling up here, I mean, you're hardly ever going to see a number like that. September 4th was 1.48. I'm not exactly sure what happened then, but you'll see a couple little smaller ones, but most of the time it's hanging out around 1 or below 1. And maybe in a later show we can go back and look at some of the previous crashes and see what they're at. Yeah, so that was something interesting I thought I would look at. And yeah, I think it's a commodity-based rally. Everyone's given up on the Fed. Don't be long the U.S. dollar in your currency trades. That's absolutely for sure over the next couple of weeks at least. I'm not the type of guy that watches something go down and catch the absolute bounce at the bottom and try to keep watching it. I'm going to look for something to happen off the bottom, like a breakout, something like that. So for right now, hold on to your commodities. Don't be long the dollar. And if this is your first time on the show, with me on the show, you're going to get a report from me called What Your Broker Doesn't Want You to Know. And it was all the things I learned in my broker training, how brokers tell you to never sell, and why you shouldn't always follow their advice, because every broker is a genius in a bull market. And in a bear market, every broker says, oh, we don't know what happened. I didn't feel like calling 300 people. So that's about it. Commodity-based rally.
Cool. Yeah, once again, no controversy. I agree with you on that, and I think we have I think commodities are going to be the place to be. I don't think the timing is exactly right just yet. I think it's more of a process than a bottom. I'm sorry, more process than an event is what I'm trying to say. For those of you who aren't familiar with my methodology, again, I have some free reports on the website, 1,400 and change YouTubes and plenty of PDFs and articles out there. And I write a column several times a week. I think the last one was 6 things that you need to do to survive and prosper in the upcoming bear market. How do I know there's going to be an upcoming bear market? I don't, but there are some signals there. And as my other fighter pilot friend Greg Morris says, we treat all signals seriously, or we take all signals. We treat all signals as if it will be the big one. And last couple times we had some of these signals. As I said earlier, the market dropped about 50% or so. And sometimes, there's a lot of talk about the death cross, and I think it's kind of stupid the way the media blows it out of the water. But the market, if you go back and look at the past, has dropped 40, 50, and even 80% after these signals before a meaningful recovery. So when you see the market rolling over like this, just pay attention. Make sure you have some stops in place. Think about a short or two, and like Neil pointed out, keep an eye out for some commodity-related areas. And I do a weekly webcast, and I flesh all these things out in a lot more detail. So stop by if you get a chance. I think that's it. Again, I want to thank you guys for being here today. A good lineup. Jonathan, great having you on the show for the first time. We're not going to pick on your poor decorating capabilities anymore. So you're free from that. We only pick on the new guy. So hopefully you'll be back soon. And a lot of good information, so appreciate that. Wiz, as usual, always glad to have you. You too, Neil. All right, let me turn it back over to David Cosbitter. Thanks, everyone. I appreciate you guys being here.
All right, thanks, guys. Just want to remind everyone who's watching that you can go to TimingResearch.com/reports to download this or any past report there. Also go to TimingResearch.com/current survey next weekend and fill out the survey there for the next report. Want to thank my guests for this week. Jim Kenney of OptionProfessor.com was supposed to be on today, but he had something come up at the last minute, so we'll have him on again in the future. Jonathan Rose of ActiveDayTrader.com, thank you for being on.
Cool. First, thanks for having me.
Matt Buckley of TopGunOptions.com and Neil Batho of TraderReview.net. Thanks, guys, for being back. And, of course, Dave Landry of DaveLandry.com. Thank you for hosting again.
Thank you, David. Appreciate it.
All right. Thanks, guys.
Cool. Thank you.